Hello traders, Gary Wagner here. It is 10:30 in Honolulu, 5:30 in New York on Friday. Happy Aloha Friday as we say on the islands, 17th day of February 2023, and this is the Weekend Review. An abrupt change in the tone and actions of the Federal Reserve has definitely pressured both gold and silver pricing. Gold has declined now for the third consecutive week. Currently, we have April gold down 30 cents at $1,851.50, and it traded to a low of $1,827.70. Considering that 3 weeks ago it traded to a high of $19.74, you can see how dramatic the hawkish tone by certain Federal Reserve members has been and what it has done to the price of gold. The dollar has strengthened a bit, but recently it has been unchanged as it is today. Currently it is down by 0.001 points or 0.00%, and the dollar index is fixed at 103.79. Lastly, silver did have a modest gain today of 0.14%, or a gain of 3 cents on the day, with the most active March contract currently fixed at $21.74. It is obvious that gold has been in a severe price correction. It has lost consistently for the last 3 weeks, declining in value week over week over week. This first chart is a Henkinashi chart. We are going to use it to ascertain the strength of the current downtrend because that is the best use of this type of chart. We can see when the pivot first occurred, which would be the small green candle followed by this large red candle. These 2 days were very large red candles with the absence of upper wicks. That is the strongest indication of a very, very powerful downtrend. However, it began to diminish quickly where the body size reduced on the following day, and then we had a series of days of either small-bodied candles with upper and lower wicks or just small-bodied candle with no upper wick. The last 3 days that has changed. On all of them, there is no upper wicks, and the body size, although it has been reducing, is still medium in size, meaning there is good strength that continues in this downtrend. And for that reason, I believe it is most likely that next week we will see gold continue to a lower value. Assuming that we are correct and gold continues to decline in price next week, the logical technical points to look at are 2 retracement levels. The first one comes in at approximately $1,815. That is the 61.8% retracement. Although that's a deep correction, the data set we're using begins at $1,719. That is the conclusion of this short correction from $1,791 down to $1,719, and it concludes at $1,975. The highest value gold has traded to this year. From there, we have seen a solid decline over the last 3 weeks. And as I said, the most logical place to look for a potential correction is the 61.8% retracement level. That begins at 1816, and it could go as deep as $1,800 or $1,775. That is a 78% fib retracement. It is extremely deep, but still within the acceptable parameters of what we look for of a defined correction. Lastly, we're going to look at a long-term study. It is still a daily chart, but what we have highlighted is the fact that as this market was in a defined correction, we had a series of lower highs as well as lower lows. That all changed beginning in October, and on November the 3rd, we began the rally that went from $1,620 up to the highest value this year. We've had a series of higher highs and higher lows. The question is, as this market comes down, we have to continue to keep within that framework, meaning we had a higher high here. We have now had a low. This low that comes in must be above the last higher low, and that comes in just below 1800. If we do not see gold find support at that point, then we have truly moved from a bull market to a bear market, rather than viewing this sell-off as a deep but valid correction. This has been Gary Wagner, wishing you as always good trading. We'll talk to you after the weekend. Have a great day. Bye-bye.